Well, natural gas futures dipped modestly during Monday's session but quickly regained their footing, signaling that bullish momentum remains firmly in play. At this stage, there appears to be little standing in the way of further upside, especially as U.S. temperatures continue to come in colder than earlier projections suggested. Over the weekend, weather models delivered a mixed bag. Some runs trended chillier, while others leaned slightly warmer. Even so, the broader timing of the pattern stayed intact. The next 5 to 6 days still look notably frosty, supporting heightened heating demand, while the 7 to 15-day window shifts toward a less intense cold regime. That said, guidance remains split. Several models keep a solid cold pool entrenched across the northern tier, while others introduce a more blended mix of mild and cool conditions. Nevertheless, thanks to a colder weather pattern and rising heating demand, the storage surplus is now expected to shrink at a much faster pace. Over the next 4 EIA reports, 3 are projected to deliver notably bullish withdrawals, each pulling more gas from storage than the seasonal norm. Traders have already taken note, and this tightening trend has been largely priced into the market over the past several sessions. Keep in mind that any deviation toward smaller than expected storage withdrawals is likely to be interpreted as bearish, especially in the current environment. Natural gas prices are trading at a noticeable premium to fundamental value, which leaves the market vulnerable to disappointment. If the next EIA prints come in even modestly lighter than traders anticipate, sentiment could shift quickly. In that scenario, the market's overstretched positioning may amplify the reaction, making a sharp corrective move not just possible but increasingly likely as overstated winter expectations get repriced. From a technical standpoint, natural gas continues to carve out a constructive pattern, with buyers stepping in reliably on dips and reinforcing a rising short-term trend. Prices are holding above key moving averages, and each pullback over the past week has found support near the short-term uptrend line, a sign that momentum remains favorable for the bulls. The market is also respecting higher lows on the daily chart, suggesting accumulation rather than distribution. The 200-day MA near $4.73 continues to serve as the market's primary line of defense, anchoring downside momentum and giving dip buyers a dependable floor to lean on. If that level holds, buyers should remain confident stepping back in. But a decisive break beneath it would change the tone quickly, exposing $4.60 as the next waypoint. Should that support fail as well, the 50-day moving average around $4.38 could be tested in short order. To the upside, the key battleground is $4.90. A sustained daily close above this barrier would likely attract momentum-driven traders and algorithmic buying, potentially setting the stage for a run toward the psychological $5 mark. Don't forget to drop a comment, hit that like button and support the channel if you'd like to help keep this channel going. See you in the next one.